gold, that barbarous relic, that shiny yellow rock. For some reason, the price is getting dangerously close to breaking out to fresh, new all-time highs. And for some reason, central banks have been trying to prevent this from happening for a long time now. And for some reason, central banks are now buying gold at a faster pace than they've bought gold for the last 70 years. So why now? Well, we are going to get clues from this by looking at the last time something very similar happened. If we take a look at just the last 30 years, we can see that there were years prior to about 2010 where central banks on net were sellers of gold. But in the early 2000s, this trend actually started to reverse. They sold less and less and less until in 2010 they became net buyers, and they've been buying a lot more recently. We can see that during the years of 1999 through 2021, the four biggest buyers were Russia, China, Turkey, and India. But just the top 10 buyers made up over 84% of all the gold buying that occurred. This shows that there is concentration. It is not evenly distributed among all central banks. Some central banks are selling, some are buying a little bit, and some are buying a lot. This is why after decades of the gold price basically moving sideways, we finally saw the gold price start to break out, and starting in the early 2000s through 2011, really a bubble formed. But even this is a repeat or a rhyme of a pattern that had occurred before. Because starting in the early 70s, the price of gold broke out from $35 an ounce and it ran up to a grand total of almost $200 an ounce in a bubble before falling down and moving sideways. And we'll get into the details of that, but both of these situations were driven by large net central bank gold purchases. And we are now starting to see the exact same thing happen now, as of the second half in the last quarter of last year. The World Gold Council reports that momentum for central banks buying gold is not slowing down. In fact, central bank demand in 2023 has had the strongest start since at least 2010. Now, we'll pull that chart back up one more time here because I want you to see that the 2022 number was relatively small. But this chart is just the total net purchases from January and February. So this is just looking at the first 2 months of each year. So you can see apples to apples here that 2023 has had a massive start. And just in case you're wondering, this is data of net purchases, meaning it accounts for all the sales that are taking place as well. You can see that of all the purchases, they massively outweigh the sales. Essentially, the pace of gold buying that we are seeing coming out of central banks right now has not been seen for over 70 years. Now, prior to this, I said that it hasn't been this big since 1967. But now, with the additional purchases for the first part of 2023, we are seeing faster gold buying than prior to 1967, going all the way back to 1950. The numbers total to a 1,136 tons of gold, which outweighs any of the records going back to 1950. And the last time we got close to this was 1967. Now, this is a significant time period because this prompted the collapse of the London gold pool, and then it prompted the collapse of the gold exchange standard. And we're gonna see why in a minute. This is actually showing that a sovereign debt crisis is unfolding right now, and the central banks know it. But first, I would like to thank the sponsor for today's video, Vaulted. Vaulted makes it incredibly simple and cost-effective to buy gold. No joke, the first time I signed up for an account at Vaulted, because I do use them, I opened up the website or the app, I signed up for an account, it took me like less than a minute. I clicked my funding method, my preferred funding method, and I was able to purchase gold. Literally took less than a couple of minutes. I was shocked at how easy it was. And the things you always want to check for with gold storage services like Vaulted is that the gold is allocated, it is segregated, it is insured, it is audited, and that you can request physical delivery at any time you want. Vaulted checks all of these boxes. They make it effortless to dollar cost average into gold with automatic purchases. You can sell your gold at any time, and if you'd like, you can request physical delivery. You know as well as I do that with any service like this, trust is going to be the #1 most important thing. And the CEO, Dave McIlvaney, I would consider him a friend. He's a very high integrity man. The company is backed by McIlvaney Financial Group, and that is one of many reasons why I personally trust Vaulted, why I use them, and I highly recommend them. Link is in the description below. So the last time we saw gold buying that was at this level or close enough to it was 1967. This led to the collapse of the London Gold Pool in 1968. The London Gold Pool was set up to try and defend the US price of gold at $35 per ounce to maintain the Bretton Woods system. But central banks around the world knew that there was not enough gold to back up this system. And that's why the London Gold Pool collapsed in 1968, because everybody started requesting physical delivery and it broke the London Gold Pool. It didn't yet, though, break the dollar peg, that $35 per ounce price for gold. So the next way to get physical gold was to turn in your dollars to the United States and get the gold in return. And that's what central banks all around the world started to do. Fast forward just 3 years, and the United States was 2 weeks away from running out of gold. That's why Nixon closed the gold window, because he looked and said, look, we know all the gold is going out. So either we end the gold standard today and we keep some gold, or we wait 2 more weeks and the gold standard ends anyway, because we won't have any gold to deliver the requests for all the other dollars coming in. So we just said, we're going to keep the last 2 weeks of gold and just end it early. But the big point here, the thing that most people don't get about this, is that central banks around the world knew what was going on. The dollar pegged to gold was sovereign debt. That is why the dollar was the global reserve currency, because after World War II, the rest of the world pegged their currencies to the dollar because the dollar was backed by gold. That at any time, you could turn in your dollars and get gold. That's why it was money for the world. And when everybody realized that the United States was about to default on this debt, because that's what a dollar was, it was an IOU for gold. They said, I'm gonna go get in line and I'm gonna get my gold, because if I don't, there won't be any left. So that's the point about this, is that central banks sniff this stuff out. The big money makes the big moves first, and central banks are the biggest money around. And they knew what was coming, the biggest sovereign debt default in the world. So they decided it's time to go get the gold. And sure enough, there was not enough gold to back up all the dollars at $35 an ounce. And all the central banks that picked up all their gold before that broke watched all their holdings increase in value up to $200 per ounce. And for the first time since 1967, we are seeing central banks start to buy gold at a faster pace than they did back then. Why? Because of the same exact reason. Central banks are sniffing out another sovereign debt default. And again, with the United States. It's not just with the United States, though. Every single government around the world has so much debt that there are only 2 options. Either there is default through inflation, meaning they're gonna pay back the money they owe, but it won't have the same purchasing power. You'll be able to buy less with it. Or they'll default outright and just not pay back the number of dollars or whatever currency it is that they owe. Either way, sovereign debt defaults are coming, and to the extent we've seen inflation have already started. Now you might be wondering why the price of gold still hasn't broken out to all-time highs if this is all true. Despite the recent strong performance of gold, it's still just hovering over $2,000 per ounce, and it has been here a couple of times already before it failed, breaking through resistance and fell back down. This is another thing that people people don't understand about what's commonly called manipulation. Central banks want the price to stay low as long as possible so that they can buy as much gold as possible. If you have the ability to buy something at the current price or to make the price go down and then buy it at the lower price, which are you going to choose? You're probably going to choose the option where you can buy something at a lower price. How does this work? It's a little something called paper gold or futures markets. This is basically where you can short the price of gold. When you short something, here's how the mechanics of shorting work. You borrow it, then you sell it on the open market, and then later to close out the trade, you have to buy it back from the open market and then deliver it back to whoever you borrowed it from. If you're going to short an iPhone, you'd call up your buddy who has an extra iPhone, say, hey, can I borrow an iPhone for a month? He says yes. You borrow the iPhone, you sell it on eBay. A month later, Apple comes out with new iPhones, so all the old iPhones drop in value. You buy the same model you borrowed back up of eBay for $100 less than what you sold it for last month, and you give it back to your buddy. You made $100 by shorting an iPhone. You can do this with gold as well by selling gold futures. The difference is you can do it with a massive amount of leverage. And so central banks can take a small amount of money and sell a lot of paper gold, which looks like sales hitting the market. And we know with supply and demand, with buyers and sellers, if there's more sellers, that means the price is going to go down, all else being equal. What do central banks do with the money they raise when they short paper gold? They use it to buy physical gold. So you use leverage to push the price of gold down by shorting paper gold. You get a bunch of cash, and then you use that cash to buy physical gold and request physical delivery. Now you might think this is criminal, and there may be some elements to it that are not exactly above board, but you can take advantage of this because all shorts eventually have to get closed out, and you close out a short with a purchase. And if the paper markets fail where all those shorts exist, then the price of gold essentially goes no ask, and you see it go to the moon because the only thing that exists then is the physical. So either way, at some point, the manipulated lower price goes away. This means to the extent that the gold price is manipulated and held lower by central banks, it is for the purpose of getting more physical at a lower price, which means you can too. This is not something I'm upset about. This is something that is an opportunity for all of us to get physical at a lower price than what it would be absent central bank intervention. And at some point, we know that the true value will make its way to the market, just like it did in 1967, the last time central banks sniffed out sovereign debt defaults. We don't know when, but we know it is a matter of time. As one final note for anybody who is looking at this as an opportunity to increase your purchasing power, just know that over the long term, you rarely increase your purchasing power significantly with physical gold. It means you maintain your purchasing power. So if we do see a move in the price of gold that mirrors what we saw in the 70s, mirrors what we saw in the early 2000s, then that means the price of other things will probably be going up a lot as well. Usually in extreme events, you do increase your purchasing power a little bit over the short term with gold, but over the long term, really not much. But it is a way to preserve your savings, to preserve your wealth. And if you would like to see exactly how the debt default, the debt spiral unwinds in the US, go check out the very last video that I posted about how the situation that the United States is in with its debt and its unfunded liabilities are utterly hopelessly destined for collapse. As always, really appreciate you guys. Thank you so much for watching. Have a great day.